Hi, this is Jim Sackman from Focal Point, and this is another of our Success Friday videos. As you know, we're working on the series about financing your business, and I spent a couple of weeks talking about different cash flow options for business owners of established businesses. I want to return to the startup of a business, and in this case, the transaction generally of a sale of an existing small business between two parties. Now, if the party that's buying it is small, going to be an owner operator very much in the way that the seller is, then one of the things that may be considered is a thing called seller financing. And what that means is essentially the seller takes on the role of the bank and loans the buyer money to help buy the business. And you say, well, why would they give them cash? They don't give them cash. What they do is they essentially accept the payment for the company over time. Now, that works like any other traditional loan. There's not really an interest calculated, but there is a schedule. Sometimes the value will be slightly higher because, it's paid out over time. But essentially, it's the seller providing financing either in whole or in part for the value of the business. There's a big tax advantage for the seller in this case because since they get their money over time, they're likely to have a tax gain by not having to pay all their taxes up front on receiving money for the business. There's a risk as well because the buyer may not do a good job and may end up not able to provide the seller with all the money that they promised them. So there's a bit of risk and reward that can happen here. One of the things that can happen is the owner could actually end up in the business, but of course, if the buyer has essentially destroyed the business, then there's not much to go back to. So that's a bit of a risk involved. There's a potential upside as well, and the way to create an upside is a thing called an earnout. So an earnout is essentially extra payment based on positive performance in the business so that the owner may actually earn more than the original deal if the business does well post-transaction. So there are ways to sort of mitigate the risk, balance the risks, balance the rewards, and this is a great way, especially combined with an SBA loan, as we talked about in our earlier way, of having a new buyer, employee, or a family member buy the business from the owner without having a lot of upfront cash required to be able to close a transaction on the business. So again, this is about seller financing, and my name is Jim Sackman from Focal Point. Change your business, change your life. Have a great day.